Good morning. Thanks for joining the session. My name is Corey Diaz. I'm the CEO of Anfield Energy. Anfield is a near-term uranium production story with all of its assets in the U.S. I'm going to walk through those assets and give you a sense as to what our production plan is as we go forward. Safe harbor, feel free to read at your leisure. So Anfield trades on the venture under the ticker AEC. Market cap currently is roughly $53 million. Our largest shareholder, single shareholder, is Uranium Energy Corporation. We have 25% of our shares held by institutional investors. And Red Cloud has research coverage on us with a 25-cent target. So reasons to invest in Anfield. We've got a large portfolio of conventional assets in the U.S., underpinned by the Shooting Canyon Mill, which is a 750-ton per day uranium mill, one of only 3 licensed, permitted, and constructed conventional uranium mills in the United States. We're strategically located in one of the most historically prolific areas for uranium mining in the United States. Only New Mexico has had more production than Utah has. We've got a good mix of current and historic resources which provide upside potential to our story. We recently acquired an asset called the Slick Rock Project in Colorado from Uranium Energy Corporation, which further bolsters our hub and spoke strategy, which I'll discuss in a few minutes. And then finally, we're a debt-free entity, and we're funded to advance our asset portfolio. So I just wanted to stop and talk a little bit more about the macro view of the uranium space and the nuclear space. Obviously, there's a lot of geopolitical risk inherent in the sector. We all know about the Russia-Ukrainian war, and Russia itself is a significant player in in both conversion and enrichment of uranium, and the West is dependent on that conversion and enrichment for a number of years and is looking for all alternate sources at the moment, given that relationships between Russia and the West are deteriorating daily. China and Kazakhstan seem to be getting closer, which means that there's a risk of material that used to flow westward from Kazakhstan will now flow eastward to China. And China is actually proposing a trading hub to be set up on the border of Kazakhstan and China in order to secure more supply to stay in the east. And then obviously the U.S., the largest installed reactor base in the world, however, produces close to 0 pounds of uranium. And the last quarter reflected that. It was less than 1 million pounds of production. So U.S. uses roughly 50 million pounds a year, but doesn't produce 1 million pounds. The renaissance in the nuclear space is also important. Opportunities are taking shape. We've got China, the UAE, India, Eastern Europe, all looking to build reactors and have reactors approved by their governments. Japan is looking to start some of its reactors that were shut down during Fukushima, and is also lifting the cap. There's a 60-year cap on a lot of the reactors, and they're all looking to extend that cap on some of the existing reactors in order to keep nuclear moving in that country. And then the U.S. recently acquired pounds from some domestic producers, roughly 1 million pounds, at an average price of $60 a pound, which is higher than what you see in the spot market today or what is being reflected in the term market. And then on the supply side, Cameco is supplying China Nuclear, Ukraine Energoatom, removing material from the North American market. Once again, we've got the U.S. with the largest installed base and material moving from Canada eastward as opposed to southward. Spain recently denied a company called Berkeley Energia a license for a Salamanca processing plant, which is 4.4 million pounds of annual production, which is essentially being removed from the market in the near term. Sput and Yellowcake continue to buy pounds out of the spot market, draining the spot market. And then Kazatomprom recently put out reduced forecasts for production both this year and next year. So the supply side is obviously tightening. So look, when you've got demand increasing and supply tightening, the only thing that's going to resolve that impasse is the uranium price increasing in order to bring more mines online. So we think we're in the right environment when it comes to getting ready for production of uranium. So in terms of our assets, you can see the picture on the top right. The yellow dot represents the Shooting Canyon Mill. The other dots represent our mines. Our primary mines are the Velvetwood, Slick Rock, and West Slope properties, and those represent the spokes of our hub and spoke strategy. The Frankham and Findlay tank are more secondary assets, which we'll look to bring on once we've depleted our primary assets. The Velvet Wood, Slick Rock, and West Slope are both vanadium and uranium mines, so we do have the opportunity to participate in both markets. We think there's a long-term conventional uranium-vanadium mine complex which will establish a strategic objective of production control. We think that in the sector it's important to have control of your own production. There are very few processing facilities in the United States. There are 11, 3 of which are conventional, and of those conventional, only 1 is currently in operation. So here are the assets. You can see the pictures on the right represent the mill, one from a close shot and the bottom one further away. Shooting mill we acquired back in 2015 from Uranium One, which is owned by Rosatom, which is a Russian state-owned entity. It's 750 tons per day. It's the smallest of the 3 existing conventional uranium mills in the U.S. Our aim right now is to move that forward to production. We've hired a firm called Precision Systems Engineering to determine how we can replace the parts that are no longer working, identify those parts, and help us acquire those parts in the marketplace in order to update the mill. Along with the mill, we have the Velvet Wood project, which we also acquired from Uranium One back in 2015 at the same time as we acquired the mill. Historic production of 4 million pounds of uranium, 5 million pounds of vanadium, has a resource of about 5 million pounds of uranium at the moment. We did put a PEA out in 2016, which returned positive economics. We're currently updating that PEA to incorporate the vanadium because we know there's vanadium there because it was produced in the past, and we expect to see that in the next 30 to 60 days. West Slope, we acquired this in 2018 from Cotter Corporation, which is a subsidiary of General Atomics, a weapons defense manufacturer out of San Diego. It has 9 uranium mines. It consists of 9 uranium mines, uranium and vanadium mines. Historic resource of 11 million pounds of uranium and 53 million pounds of vanadium. We did put a report out early last year, which included 4 of the 9 mines to try to determine what the best foot forward would be or path forward would be with regard to these assets. We do have a resource of 5.4 million pounds and 27 million pounds of vanadium, 5.4 million pounds of uranium on those assets, and we're now updating that resource to include economics. So we'll have economics for both Velvet Wood, for vanadium and uranium, and the same with West Slope. And then the Slick Rock project we acquired from UEC through an asset swap last year, April or May. That has a resource of 11.6 million pounds of uranium and roughly 70 million pounds of vanadium. So we are one of the largest holders of vanadium as a public company in the United States. And we have uranium resource of roughly 30 million pounds. So we're currently working on an updated PEA for Slick Rock. There was a PEA put out in 2014. We're now updating those numbers, and we expect to have that out in the next 30 to 60 days. So the aim here is to understand that these 3 assets are the spokes for the Shooting Hub, and as we understand the economics related to these assets, we'll be able to tie them all together in order to put out a global financial model that relates to our plan for Hub and Spoke. Steps to production, as I mentioned, we're now working with a group called PSC to outline the mill activation plan. We're also working with the state of Utah to update the current license for the mill, the radioactive materials license, from its current standby status to operational. And we're updating the PEA, as I mentioned previously. We're also looking at West Slope, updating not only the West Slope project related to the 4 mines that we put resource on, but the other 5, which we could potentially look to add economics to. And then finally, Slick Rock, we're working on the PEA today. We expect to see that out in the next 30 to 60 days and be able to tie that back to the mill. Just a little bit more detail related to the assets that we consider our primary production assets. Velvet Wood, acquired from Uranium One in 2015. Historic production, as I mentioned, 4 million pounds of uranium and 5 million pounds of vanadium. At significantly high grades for the U.S., 0.46% uranium and 0.64% vanadium. we're working on an updated plan of operations to get the milling license back up, or sorry, the mining license related to Velvetwood up and current. West Slope, acquired in 2018 from Cotter Corporation, 9 mines with historic production of 1.3 million pounds of uranium and 6.6 million pounds of vanadium. You can see on the picture to the right, the adits are open. There's material within the adits. It's very easy to restart these mines, less than $1 million per mine. So these will probably be earlier stage materials that will flow through the mill. Slick rock, you can see the picture to the bottom left. I'm not sure if you can read it on the screen, but SR13A, which is the blue shape on the top left, which sits right next to the green shape, which represents slick rock. The blue shape is actually one of our West Slope mines, so it shows you how close in proximity this property is to our West Slope property. So we can potentially add some of the mines that we don't include in our initial PEA related to slick rock into a resource for, or an updated resource for slick rock. So in terms of peer comparison, this is always my favorite slide. We compare ourselves to a number of US-based near producers and developers. The companies to the immediate right of AEC, which is the box on the far left, are all of the companies in the US which have processing facilities. We are one of the 5 with processing facilities, and yet our market cap is dwarfed by all of the players in that space, and not every one of those companies actually produces today. I think the flip side of that is that our potential upside to meet the smallest of those peers is roughly 7 times where we are today. So we think there's significant upside in terms of our valuation. We have a similar asset portfolio, similar mix of assets, and yet we trade at a discount because we're less known in my view. But I think there's the opportunity inherent in the sector when we look at our valuation vis-a-vis our peers. The other companies on the list further to the right don't have processing facilities, and some may have relationships or some kind of understanding with other producers or other parties with processing facilities. However, none of those holds its own. So we think that our valuation should probably be more akin to those who hold processing facilities than those that don't. And we think that there's significant upside as a result in our story vis-a-vis those peers. A little bit about some of the directors of the company. I won't talk about myself, but I will talk about Josh Bleak, who's another co-founder of the company, Arizona-based 4th-generation mining family, has worked in uranium for a number of years and is our man on the ground in the U.S. Don Falconer has worked both in private and public markets, worked for Ontario Power Generation in the nuclear division, and has sat on the board of Energy Fuels and other publicly traded companies. Ken Mashinsky, our most recent joiner of the board, who's now the chairman, over 30 years of nuclear-related experience at General Atomics. As I mentioned, it's the weapons defense manufacturer out of San Diego, and has worked for a number of his subsidiaries, including Cotter Corporation, so he has asset-specific experience related to our company because he sold us the West Slope properties. Quasar Resources, he was the president of that company, which is an Australian-based uranium producer, 5 million pounds per year, so he's very familiar with operations when it comes to production of uranium. And he was on the management committee of Converdyne, which is the U.S. conversion facility, a joint venture between Honeywell and General Atomics. So well-versed in the sector, plugs a number of gaps that we had previous to his joining the board, and certainly will be there to help us as we move forward towards production. And then Steve Lunsford, 40 years of experience as a geologist, so he helps us as we acquire assets and determines the value of those assets when we look to acquire. And these are just another couple of assets that we have represented by the blue dots that I showed earlier. The Frank M deposit, which is very close to the mill. It's strictly uranium, and it's a lower grade, but could serve as a feed mill mix as we bring material in from other mines. And then Finley Tank in Arizona, that's a Brescia pipe project, which is a secondary asset for us. There's a potential of us combining that with a couple of the acquisitions that we recently made in Arizona, both Artillery Peak, and the Dripping Springs core site project.